Choosing the right structure is one of the most significant tax decisions you can make with the autumn budget of 2025. Changes are looming, and the main math is changing as well and shifting for the 26-27 tax year. Sole trader versus the limited company, 26-27. Traditionally, switching to a limited company saved money once profits hit £40,000 to £60,000. Right, 40 to 50,000 actually. However, with the upcoming 2% increase in dividend tax in April 26, the tipping point is moving higher. Now, one of the main things I like about limited companies is why pay now when you can pay later, and who knows what might happen, you mightn't be in business then. Anyway, let's talk about the main features. So the sole trader, it's 20%, 40% and 45%, whereas corporation tax is 19 to 25%. But remember, that's on all profits. You don't have no personal allowance. National insurance is 6% class 4, whereas 15% on a salary. Profit access, you can draw your money anytime as a sole trader, but mainly people use dividends as a limited company, which is 10.75 or 35.75. There is ways to take your money out before then, by the way. Main thing, your personal assets at risk if you're a sole trader, but personal assets are protected if you're a limited company. Now remember, there's problems there if you start negatively trading and things like that. Now the admin side, it's low for self-assessment, and you could say it's higher for Companies House, especially with this new ID check you've got to do, which you can understand because I had people calling themselves Darth Vader and all sorts. And now, but with self-assessment, they're doing this where it's every 3 months. So my verdict, the profits are constantly under 50,000. The extra accountancy fees offer an extra £1,000 a year, or higher if dividends may make being the sole trader more efficient, so far less stressful. If you earn over 70,000, the limited company structure still usually wins out, where you leave your money in the business to avoid 40% in the tax bracket. Now, I did cover this before, but calculate on your home office deduction. There's two ways of doing it for the 25-26 and 26-27 ways. Now, there's a simplified expense method. So if you work more than 25 hours from home, you know, because a lot of people had to after the disease and all this carry on, or working from home now, where people want to do. You don't need receipts for utilities, so 25 to 50 hours, £10 per month, 120 a year. 51 to 100, £18 a month, 216 a year. 101 hours plus is £26 a month, 312 a year. Now, method B, what they use, which they call the tax saver way, which is a nightmare really. If you have deducted an office room and high electricity bills or energy bills, this is always better. The formula, total household bills. So get your total household bills together. I'll give you an example. If you have a 5-room house and use one room as an office, 50% of the time, you can claim 10% of the total rent, mortgage, interest, council tax, gas, electricity and water. Now, the other thing we should look at, I suppose, is what they call the dividend rush. Because dividend tax rate's going to rise by 2% on April 2026, and if you have a limited company with spare profit, draw the dividends out before the 5th of April 2026. Savings on most 30,000 dividend, you would save £600 in tax just by taking it a few days earlier. I like it, 30,000. You would like to run specific calculation, you give me the estimated annual profit and the monthly household bills, and I can tell you exactly what the home office method saves you, more or whether a limited company is likely to be tax positive for you. So I can help you out with that if you give me the information.